Welcome to the Jay Martin Show. My name is Jay. If you're new to the show, I'm an investor looking for the smartest home for my cash. Maybe that's just like you. If it is, I think you're going to like what we do here. Now, my guest today is E.B. Tucker, best-selling author, serial entrepreneur, and legendary investor, as well as just a crowd favorite here on my channel. And I love catching up with E.B. Today, we talk about what happens when investors do too many steroids. And what we're talking about, obviously, is stimulus and cheap money flowing to the market, financing companies that should not be financed. And there's always a day of reckoning that comes when that cheap money or the steroids wear off. And so we talk about the withdrawal symptoms today. We also talk about how to make money in the copper sector and where he and I are finding value in the market. I really enjoyed this conversation. I know you're going to as well. As always, if you enjoy my style, I write a weekly op-ed I publish every Sunday where I jump into the nuances of investor psychology. I talk about the heuristics and biases that cause our best and worst decisions as investors. And I think this is mission critical. Even though I manage a portfolio of cash and companies, what I write about is managing my mind, which is the most important tool in every investor's toolkit. And over 40,000 investors hear from me every Sunday. They seem to love it. I get great feedback and I love writing it. I learn a ton and my audience does too. There's a link right beneath this piece of content where you can subscribe to my weekly newsletter. Just hit that link. But here is E.B. Tucker. Enjoy.
This is Jay Martin.
All right, here I am with E.B. Tucker. E.B., it's great to see you. Thanks for coming back on the show.
Thanks for having me.
I want to start with your most recent newsletter, the Tucker Letter, which, first of all, I recommend everybody reads. It's a bi-weekly op-ed that you publish, always entertaining and super informative. You're a great writer, and I always learn a lot. Last edition was on the Webvan story, which is, one of the companies in the late 90s that received a ton of very cheap cash, grew remarkably fast, but never really produced anything and came crashing down. And the story was kind of discussing the similarity between cheap cash in finance and steroids in sports and how you can see this quick rush and upside that inevitably ends badly.
Well, it's funny because reading that, when I was going back and what happens is, just so people understand, is like, I've been doing research for 25 years. So what happens is you get into these rabbit holes and it's just so much fun because you go back and read these things that were written years ago and you can't believe it. I mean, some analysts actually wrote that in the 1999 boom, that it was like steroids, like the more you can take, the bigger you get. So like, how many can you take? That was, he was saying basically about taking on money. I mean, he was like, the more money you throw at the new idea, the bigger it gets. So like, just throw as much money as possible and it gets, huge overnight. And the guy was like, yeah, it's like steroids. and you think, you and I are old enough to know people that did a lot of steroids and you're like, yeah, it's not a good idea really to do steroids. Cause I mean, you just like your body is like, it changes the whole way everything works. Like you have this in your body, you have this homeostasis that goes on all the time, like this balancing effect that your body, it's like a magical thing that our bodies are capable of doing. And when you throw in like tons of anabolic steroids, you get like huge arms and stuff, your body does all these crazy things, and then like 10 years later, the doctor's telling you like, probably wasn't a good idea to do all those steroids. And, you don't even have the biceps anymore to show for it. And that's the thing I think people don't understand about like what happens with free money. When you have free money, it doesn't spend the same way as hard-earned money. Like you don't spend that money with the sort of diligence that you do with money that when you break a sweat for the money, you really think about the decisions differently. I remember years ago, this old guy told me, he's like, if you want to live on a budget, don't have a credit card, which, by the way, I'm not an advocate of this, but he said, go to the bank and get the money you need for the week. And it's like, you'll be much slower to spend that money. And I was like, this guy doesn't know what he's talking about. But what he was saying was philosophical, right? Like when you had a credit card back when I was coming along, it was like, you go with a credit card, boom, you just whatever you want, right? And think about it later. And he was trying to say, like, when you got to part with those bills, it's a different mindset. And it's so simple. And I think as we look at the investment climate now, you just think there's trillions of dollars of money that created all kinds of distortions. And so our job as investors is to stay out of the way as some of those distortions cave in. Because you got to remember, Webvan went to zero. I mean, it went to zero. It went to zero in a hurry. Okay, and it was a hot IPO, like really hot. And 18 months later, it was worth like a tenth of a penny. And what's crazy is that the whole premise was they're going to bring groceries to your house, which you can now. We have that, and so sometimes like the actual idea is a good idea, and so people get hung up on the idea. It's like that was the problem with some of the crypto coins, was they would tell you about this idea. You're like, yeah, you're right about the idea. But the problem is like it's probably not going to be that coin that makes the idea happen. And so you got your life savings in that coin. It's like, you might want to be careful about that. And I think people really struggle as they get hyped up in the idea that like, I'm going to change the course of history and I'm going to make a fortune and it's going to make my life totally different. And so I just think sometimes it's cool. Like, people are crazy not to be reading the Tucker letter. Because I mean, it's, first of all, you read it for free, but I mean, most of it at least. But the thing is that like all these things just keep happening. They just keep happening. And so when you go back and you spend a few minutes learning about a thing that happened 20 years ago, it gives you a fresh pair of glasses to look at today. And that's like the thing that I think people undervalue all the time. I mean, that's what, you and I do all the time. And that's what we know is like most valuable, is that you want to like take a break and get out of yourself for a minute and look at it and say, okay, what's really going on here? And what do I want to do about it?
Yeah. And the Webvan story, it struck me for a couple of reasons. Number one, just the name, honestly, in 1999 to come out the gate with a company called Webvan, when everyone is flooding to anything web-based, and you have this grocery delivery service, which sure, 20 years later ended up being a pretty good idea, but 20 years ago was tough. They raised an insane amount of money, like $500 million in venture capital.
Yeah.
Another $350 million when through their IPO.
Which, by the way, that was a lot of money. That was a lot of, like, nowadays people are like, it's not that much money. But back then it was like a colossal fortune, right?
Yes.
That was a lot of money back then. Yeah.
A lot. Yeah. And I think their spend on their 26 facility build out was $1 billion. When they became insolvent and hit receivership, their assets were liquidated. As I understood, most of their assets were just groceries, which were sold to a grocery outlet store, which then just resold them at a discount. And I found myself wondering, like, what are today's Webvans, right? What are the companies that have received an obscene amount of extraordinarily cheap capital, grown far faster than natural or should have, and are having their day of reckoning? And the one that we've kind of seen come and go maybe is Carvana, right? The idea that people start buying cars from vending machines. Maybe it was early. I don't know. It seemed nuts to me, but they ended up running about $1 billion deficit when everything came out. And do you think there's a pocket full of companies that are in that Webvan scenario as a consequence of all the cheap cash that we've seen over the last 5 years? And there's a reckoning coming, E.B.?
Yeah. So I get, as you can imagine, I get like a tremendous amount of information, coming across my desk all the time. And so one of the things right now that I'm fascinated by, and anybody at home can do this, is that there's all these sites like Equity Zen and all these things that what they'll do is they'll give you access to private investment rounds for private companies. And I don't actually invest any money in these, but I sign up for all of them so that I see all the deals. And right now, what I'm noticing is that almost every deal that comes across is what's called a down round. And a down round means that if the company raised money at a valuation of, say, $1 billion 2 years ago when things were hot, they ran out of money and they need some more money. And so it's what you would want to happen would be to raise money at $2 billion, which would mean that the valuation was higher. But instead, they're raising money at, say, $500 million, which means that they're raising money at a lower valuation per share. Even though it's private, it still works the same way. They're selling stock for less than they were 2 years ago. And so almost every deal that I see is having a down round. And when you see that, it tells you that there's some air coming out of the balloon. And I think that people need to understand right now that we are in basically the financial equivalent of purgatory. Okay. And by the way, if you ever go to Rome, there's a museum called the Purgatory Museum. It's hard to find. I found it. I'd seen it online, and I had to go see this. It's a whole museum of purgatory. It's not very big, and it's really amusing. But basically, the concept is you're in this kind of like waiting room between two different realities. And we are in this purgatory period. And what that means is that what the Fed is trying to do is they're trying to withdraw as much hot air from the system as they can without creating a problem. Now, a problem is defined as people start freaking out and destabilize the system and insolvencies. And you're seeing, think about it, what we've seen this year. We've seen banks go bust. We've seen private equity firms right now are struggling badly. There's a lot of real estate partnerships that are fumbling around trying to extend loans and figure out what they're going to do to refinance. And what you're seeing is the most sensitive borrowers that needed 0% money to. I mean, imagine if you can't make your company work at 0%. I mean, 0%, like, is basically all the money you want. So okay, now 5%, people are like, whoa, 5%. I mean, we can't possibly pay that much. So this is still ongoing. And people say, well, is the Fed going to raise? Is it going to pause? The Fed doesn't know what it's going to do. It's going to keep rates as high as it can for as long as it can to suck money out of the system until it creates a problem, and then it's going to have to turn around and to add more money. There is no such thing as recessions anymore. This is a managed economy. This is a system that is not capitalism. This is managed capitalism. And what they're trying to do is they're trying to organize basically a way. They think about it like if you're a drug user and you try to be able to be up for the times you need to be up, and then down so you can rest, and then back up when you need to be up, and then not depressed on Monday, and then partying again on Wednesday. So, I mean, imagine if you were trying to, like a chemistry project, you're trying to constantly manage this, and you can't do that. You just can't do that. I mean, you can do that for a little while. You can do that for some period of time, but you can't do that for a long time, because what happens is that you mess with the natural flow of things, and you get outcomes that are not normal, and they're strange. And so what that means is that, like, businesses that don't make any sense somehow, end up somewhere really big and important and all these things. And then businesses that you actually need them, nobody wants to do them anymore because they don't make any sense. And so, look, we don't have to solve all these problems. Like, sometimes people get way too wrapped up in, like, well, the Fed is immoral. It's not really like that. I mean, it's just once you kind of back up a little bit and you just see, like, okay, so what does that mean? Well, I mean, look at the interest rates. Like if you loan the U.S. government money for 10 years, you pay like 3.78 or something is what they pay you. And if you loan them money for 4 weeks, it's like 5.3. So, I mean, that's a total problem. I mean, that means that, like, they pay much more to borrow for 4 weeks than they do for 10 years. And so we don't have to get into why that matters. But, like, whenever you see that, it means that things are, like, massively out of sync with kind of what would be considered a balanced flow. Right. And so during that time, the number one thing people watching this need to understand is it is not a good time to gamble. Okay. It is not a good time to gamble. And don't take it from me. Just ask yourself and your friends, how's your gambling going lately? And the answer is, it's not going that great. So, like, you and I keep track of all the Vancouver companies. Like, there's not a lot of, like, hot success in Vancouver. I mean, I recommend that anybody that with an attachment to the Canadian mining scene, have a broker, right? Like, don't just have, like, a discount broker, but, like, get yourself a broker. Now, the reason I have several brokers, and the reason I have them, and they're very expensive, by the way, they charge, like, huge commission, but they're very useful because you call them up and you're like, how's it going? And they'll tell you how it's going, right? They'll tell you, like, if something's hot or if nothing's hot, or they're like excited to talk to you, because you pay them a lot of money, but they'll tell you what's going on. And I find that very useful. What they're telling me right now is that it's extremely dead. And so my point is, when the Fed is in this mode of pulling all this money out, you don't. It's not. You could gamble on anything in 2020, 2021. Anything you gamble on pretty much worked out.
Yeah.
And so right now it's the opposite. I mean, so in my letter, at the end of my letter, we run a portfolio, and people hate the portfolio because there's only stocks that are up like 20%, and they want to make like 2,000%. But it's just ridiculous because this is a marathon. This is not a sprint. This is a marathon. And if you can beat the index, and you can have better than average returns with lower volatility, that's all you got to do. I mean, you're going to get super rich, right? I mean, we're buying, like, there's several companies in this week's letter. I'm writing at the end about several companies that we own are buying tremendous amounts of stock back. Like they're publishing, every month that they're buying like 0.5% of all the stock. And that's a lot of stock, right? I mean, like, it's a huge amount of stock. And what that means is that you have a slice of the pie, and your slice is getting bigger and bigger because the company is making all this money. And they're like, it doesn't make any sense to reinvest in the business or just buy the stock back. And nobody notices. I mean, this is like multi-billion-dollar companies. I mean, nobody notices. People are just like, yeah, whatever. I want to gamble. I want to talk about NVIDIA. That's what I want to talk about. And NVIDIA is not bad. I mean, it's not. We wrote about chips. We have some chip stocks in the portfolio, but I mean, but it's too like myopic. It's too. NVIDIA is a huge company now. I mean, it's just really, really big, and so people get fixated on these things that become very popular, and they miss the big picture. That, like, you got to buy companies that are making money and that are in an uptrend on the chart, and that are in industries that you think you're going to get better. And what that means, to get better, is it means that, like, the wind is at your back in the business. It means that you're going to have an additional customer every day instead of be losing a customer every day, right? So that's what we do, and I just think people just hate it. I mean, because they want action. They want action. But my suggestion is, get your action somewhere else, and don't bring your need for action into your money life, because it gets super complicated. Yeah.
I publish a weekly newsletter every Sunday. If you would like to subscribe, hit the link right beneath this video. Now, I'm an investor, but I don't write about managing money. I write about managing my mind. Without question, the hardest and most important part of allocating capital through volatility and getting some back. If you want to read my newsletter, hit the link right beneath this video. I know you'll love it. Now, back to the interview. Enjoy. Oh man, so much in there I want to pull on. Okay, so I'll start with a few things you said about, you drew parallels between like drug withdrawal and a reduction in cheap money, and, a managed economy creating an unnatural environment with higher than normal growth and all of this stuff. And what you made me think about was this study I read recently coming out of a university in Spain, where they were experimenting with the growth rates of goldfish, and they had goldfish placed in colder than normal temperature water, and another goldfish, a sibling, placed in warmer than normal temperature water. And the goldfish in warmer than normal temperature water would grow remarkably faster, grow muscle tissue, skeleton, everything would grow, and it would put on mass a lot quicker. Then they'd take both fish and put them in their natural habitat temperature water, and what would occur is that they would both revert to the mean. The smaller goldfish would grow up to the mean size, and the larger goldfish would actually lose some mass. So it looked like everything returned to normal, except that the goldfish raised in warmer water, its life expectancy would be reduced by about 16%, whereas the goldfish raised in the colder water actually had a life expectancy increase by 30%. And it's a silly, like, natural world analogy, but like it's I think these natural laws apply to us everywhere. And that is just one, right? That you can expedite growth, but it comes at a cost. And even when things return to normal, you built on a shaky foundation because you built too fast, because the resources were too accessible or too cheap or whatever. But it struck me as like, that's kind of what we're looking at here.
I love this, because this is very, very philosophically true, right? And in my life, so nobody really knows what I do, like in my social life and all these things, like nobody can. I don't even try to explain to them. Like, I just do business stuff. And once I get to know someone, I try to like explain to them that I decided a long time ago that this is what I wanted to do with my life. And in order to do this, I had to make certain sacrifices. And one of them was to not live above my means, because it's not because I have this as like a value or something, or like I'm some Quakerish kind of mentality, because I'm not. I love to do fun, nice, expensive stuff. But I figured out a long time ago that if I lived far beyond my means, that I would be subject to shock events that would require me to then go back to work in an office building and answer to some guy with a cell phone clipped onto his belt that was barking orders at me all the time. And I couldn't do that. I just couldn't do it.
Yeah.
And so I came up with this like management system for my life, which basically looks kind of like picture like buckets, you know. And so any time that I would have any sort of success, I would kind of like divide things into these buckets, and the buckets are like incredibly stupid, you know. Like there would be things that I would do with money that like made no sense, and you know, like I live in a smaller house than you would expect. I mean, it's not like a tiny house or something, but I mean, and it's like an extremely cool place, by the way. It's architectural home with like 2 buildings and big wall around it and stuff, but it's not that big, and it's also not like really that expensive. I mean, but I don't have a mortgage, like. So people say, yeah, I mean, you could live in a house that's like 4 times, 5 times the cost. And I'm like, exactly. But if I go through a stress event, I might lose the house. And I would probably lose the house at a time when nobody's buying houses, which means that I would like lose the house and then some. You see how this goes? Like with what you're talking about. And so I just, like a long time ago, I just decided, I mean, I would basically rather like live like a peasant in some ways, but not be subject to shocks.
Yep.
And like the goldfish, like that was in the cold water, it's like that you actually live longer. And so like financially speaking, you know, you live longer because you're not subject. Now, okay, here's where it gets complicated. You still need to have exposure to big upside, right? So for the goldfish, it's like you still got to have exposure to the occasional, when you run across a big pile of food, you got to be able to like benefit from that. And so the way I've done that is that, you know, I've started the companies that I couldn't find in the market. Like I started, you know, Metalla with Brett Heath because we couldn't find a royalty company that fit our desires. And by the way, they just announced a special dividend. I mean, I think people miss this, I think, because they're too busy, whatever they're doing this summer. But what happened was we bought these royalties in 2020, and one of them was like cost almost nothing. And Barrick, you know, developed a mine next door, and they wanted the property, and so they bought the property for $5 million, and we put a royalty on it and sold them the property. So we still have a royalty. It's amazing. We still have the royalty, and we got $5 million. So we had to pay some tax, all these things, but we did a special dividend. And I think people say, "Oh, it's not that much. It's only 0.5%." It's like you're missing the point. The point is that you got like 80 something royalties, okay? And these things are like really right place at the right time. I mean, it's like in a fishing boat when you have like 80 lines in the water. I mean, like you start really catching fish, man. I mean, when you run across a school of fish, I mean, you got like so many lines with fish on them, you can't even manage all these things. So, I mean, we have all these royalties, and these things, you know, we did all this hard work like 5, 6, 7 years ago, and now you're starting to have a harvest. And what's crazy to me is that the gold price is moving and the stocks are not moving. Like the royalty stocks are not moving, and there's no money coming into them, and they're paying, you know, think about it, special dividend. I mean, it's like, it's just a trend in the making. This is not just like an accident, like one thing. And I just think people, so you got to have this stuff. We did Nova royalty, the same thing with copper, because there's not enough copper, and everybody's like, well, you know, Nova came out and then it went down. Yeah, but I mean, Nova's got, you know, almost 24 assets and keeps getting deals done. And if anybody that's been reading the news realizes that there's something going on with Nova, you know, the company is exploring its strategic options at the moment, which I think kind of everybody can keep track of the news and understands what that means. But there's just, copper royalties are super rare. And so my point is, I started that because I don't want to just buy like Hudbay or Freeport McMoran or something like that to own copper. I wanted to own copper royalties. And the only company that really owns a lot of copper royalties is Franco-Nevada. And, you know, if you buy that, you get like gold and oil and all this other stuff. I don't really want that. So we started Nova. We bought these 20-something royalties, and nobody cares. And you're just like, but these things go for like 100 years. I mean, it's really crazy. I mean, it costs billions of dollars to make the copper mine. It takes a long time, and they produce for 100 years, and nobody wants the stock. It's really nuts. I mean, like, so these two things go together. You know, like the cold water goldfish. If you can be the cold water goldfish and you could also stay exposed to upside at the same time, to me that is like perfect, because that's what's gotten me here. You know, because everybody's always like, well, how did you? How did you? Yeah, well, I hate to tell you, but I created this like cold water habitat for myself, and then I tried to get involved in upside when I could. It takes forever to do that, by the way. But right now, you know, we're in this environment where you can get you can just buy the upside in the market. You just buy it right there. Nobody wants it. And so it's just amazing to me, because people, they demand some kind of like secret to get ahead. And we're giving you the secret right now. We're giving it to you. It's so easy. We're telling you. And you read my newsletter, you read it all the time, over and over again for free. And people don't want to do it. So it just shows me that everybody is on their own journey, and they don't really want good advice. What they want to do is to make mistakes and blame other people for them. And that's okay, you know, because maybe we did that years ago too. And, you know, we needed somebody to be like, you know, you'll be all right. Don't worry about it. But there's a lot of truth to what you said.
Well, and what you're saying there is like rule number one is stay alive, right? You know, own the house, build the rock foundation. You know, what made Warren Buffett such a successful investor? Well, the first thing is that he's been an investor for 80 years. I mean, that's the first thing, right? He stayed in the game for 80 years, never got cleaned out, right? That's step number one.
Yeah.
And, you know, had he started his investor journey in his mid 30s and quit when he was 60, he'd be worth about 1% of what he's worth today. Right. But because he started in his teens and he's still going in his 90s, he's worth what he is. But it's just compounded returns. And, you know, I'm the same. Like I definitely keep my finger on the pulse in the speculative world. I love it. But it's the barbell approach. It's like rule number one is stay alive, make sure the foundation's tight so that if things go really south over here, I'm going to be okay. Right. And then I can go out there with courage. Right. And chase down the high risk.
Because you're not, you know, being like ultra conservative, where you know, because we all know those people that are like, I don't take any risk, and you're like, well, you're not ever gonna advance. I mean, ultimately, you have to have exposure to wealth creation, or else you're never going to get ahead. But I think what you're saying is the problem is people confuse what those things are, you know, and they take risks that don't make any sense. I mean, they take, when the Vancouver market's super, super hot, you know, they're ready to take a risk on something that doesn't make any sense. But then when nobody, like when I phoned the broker and he's like, nobody wants any of these stocks, and I created, you know, 2 of these stocks for myself. I'm like, I nobody knows better than me what's in the cooking, right? You know, it's amazing. So like, yeah, I mean, you're gonna take the risk when you got to pay a fortune for it, or you're going to take the risk when, you know, they're basically giving it away. I mean, that's the art of it, you know. But it's a lifetime journey, because we've all made errors getting to this point. But people, right now is a time to wake up and to say, all right, what's really going on here? Because if I can own that upside for 10 cents on the dollar, I mean, whoa, that's the time to move.
100%. Okay, so what I'm doing right now, I'll share with you, is I'm looking at a handful of gold producers. They're mid tiers, producing like 150 to 350,000 ounces per year with a path to 500,000 and a vision for 1 million. The reason I'm looking at those companies is because I can walk in with no competition right now, and nobody cares. They're great companies spitting out cash flow, and nobody cares. Where are you looking, EB? Like, what's catching your eye right now?
Yeah, so those companies you're talking about, you know, if they're in good jurisdictions, they'll probably get bought. That's what will happen. I mean, there's like huge M&A going on, and the big companies have bought up about everything they can buy, and so I think the question becomes, how are they going to make the next move? I mean, the gold price obviously is made an attempt to go higher 3 times. I mean, if you look back at the chart, you know, you had this you know, COVID shoot up, and then you had August of 2020, you know, COVID shoot up. Then you had boom with the Ukraine invasion, And then you had boom earlier this year, you had it again. So I mean, now it's ready to move. If you see on the chart, it's like it's ready to go. And people don't understand. So what that means is like, what does it mean ready to go? Well, it means that gold is well managed. Okay, we're gonna, in the Tucker letter, we're gonna talk about what moves the gold price. I think we're gonna answer this question because I actually know what moves the gold price, and I'm gonna explain this. Not this issue, but I got to talk about Japan for a few issues, but after that. And I think people are going to see it's pretty well managed. Like you're not going to walk in one morning and the gold price is like $1,000 higher. It's not going to happen, and because it's controlled by there's a methodology to it. But what you are going to see, and if you look back 20 years, you'll see proof of what I'm talking about, is that occasionally it makes a little stair step up to a new level. And so let's just say that new level is like 2250 or something. And people say, well, it's only 10% higher than here, maybe 15. How am I going to get rich trading that? Well, you're not. But what's the value of a royalty when it has 30 years of cash flow ahead and the price goes up 15%? And when if you went to school for finance, you know exactly what the answer to that is. And the answer is worth a lot. So that's really where my focus is at this moment. That's where my money is. I'm on the board of these companies. People can see that, and I think that there's been a lot of consolidation. There's been maybe 7 or 8 small royalty companies bought in the gold space. There's been more in the base metal space, and so that's playing out real time. And I think people should get a list of those companies and get like a watch list, because you can like sign up for these watch lists for the news and everything, and just sit and like you're fishing on the side of the creek, and wait and watch, because the news flow is crazy. I mean, it's you see what's happening with copper, right? Like Newmont, Newcrest, and Barrick making a run at Quantum. I mean, it's nuts, man. I mean, think about Barrick putting that news out on Quantum. I mean, it's like, what is that about? It's like a hostile swipe, and it means that they're just hungry. I mean, Oz Minerals, like, there's been so many deals, and the copper situation is dire. I mean, there's just not enough. There's not enough copper. Well, that move is only going to happen one time. That's it. Right. It's only going to happen one time. That's it. It's a one-shot deal. It doesn't move and then come back and pick you up and then move again. It's not like that. And so what do you want to own? Now, the reason I like royalties better than the miners you're talking about, well, I do think a lot of those miners are going to get bought, which is pretty good because you get, that tends to be your biggest. That's the time you want to own those things, is that you get those little pops. The reason I like them better is because the royalties I can hold for a long time. Like right now, the royalty business from a stock standpoint is terrible. Like you can buy these stocks cheaper now than you could when they were acquiring all the royalties, which is crazy. But the thing is that if the market is tough for a long time, I can own these things and not have to worry, right? So the reason why is because I've already paid for the royalty. So basically, like with the mining business, I might have bad capital markets. I might have a mudslide. I might have some expenses associated with like litigation or something, and those things add up, and then I need money, and then I've got to issue a lot of shares to get it, or I got to do a rights offering, or things get really complicated. Whereas with the royalty business, people, if they track this news with Nova, for example, they see a company can hunker down, and it can tighten itself up easily because its ongoing operations are really minimal. I mean, there's no, talking like 3 or 4 employees or something, and you rent like sublease and office space. I mean, it's nothing. When you have the mining company, you got like a couple thousand employees. It's very complicated. And so again, if you can own that miner for that acquisition, boom, that's good. But if you told me 2 years ago the gold price would still be struggling to crack 2,000, I would have thought no way. So right. So I think that's proof that, I mean, if we have this unknown period of time to wait, then I want to wait with a royalty because I don't lose exposure to that upside when it comes.
I'm with you there. And I when I look at Nova's assets, it strikes me as a company that could could probably do nothing, EB, and would be more valuable, much more valuable 5 years down the road. They could do nothing at all because those assets are just going to mature, right? And start spitting out more cash. They've done the right deals. Definitely the first mover in the space. There's no company like them, which, attributed to the run up in the share price a couple of years ago, kind of a victim of their own success. The market got really excited about what you guys were building. I get it. And you can't build a second Nova, can you? Because you can't get royalties on those mines twice, right? The deal
Yeah,
that
people are crazy with copper. I mean, it's like there's a lot of gold royalties. There's a lot of gold royalties out there. I mean, you can find small mines and little royalties here and there. And but the thing is, like, copper mines are pretty rare because you got to think about it. Gold's priced in ounces, right? So like troy ounce of gold, $2,000 basically, but copper at like $3.75, call it even $4 a pound to be generous. When you're talking like 35 cents an ounce or something like that. I mean, it's just do the math, right? I mean, you have to like dig a hole, the size of Toronto, to dig enough dirt out of the ground to process enough copper. I love flying into Salt Lake City Airport, and you fly over Bingham Canyon. I'm sure you've done this before, and that's like a copper mine that Solomon Guggenheim was putting into production 100 and something years ago, and the price of copper was I think it was like 10 cents a pound or something. It was really cheap. And you imagine if you had a 1% royalty on that, because 100 years later, you'd still be receiving the royalty. It's totally crazy, right? I mean, it's. I think people just don't understand how different copper is, and the copper boom is underway. And people are like, well, the price is going up. Yeah, I mean, the price is looking okay, to be honest with you. It's looking pretty good. It's pulled back, and the pullbacks in an uptrend are where you want to take action with anything. I mean, everybody looks at these charts and they're like, I want to buy the absolute bottom, but you really don't actually. As something starts, I write about charts in the newsletter, and like I explain, I have like one chart that I use most out of any chart. And what you see is that you're an uptrend and you pull back, and you do this little dance going higher. So every time you pull back, everybody's like, doesn't trust the rally. But that's like the time to make a move, because you get a chance to jump on before the next uptrend. And it's like we're talking about big stocks here, and like we're not talking about like tiny stocks, but uptrend is an uptrend, and when something's in an uptrend, it's really good you just get involved in the trend, and you just look at these. It's been so long since commodities have really attracted a lot of money. It's been so long. It's just so long. I mean, if you take like shale oil out of the equation, it really puts a spotlight on how long it's been since you had a real commodities rally. And agriculture really doesn't count, because there's been a lot of genetic modification that's created efficiencies in agriculture, right? And that really hasn't happened with mining, because
it hasn't.
Mining is still pretty crude, and so you haven't had those benefits. And some of the copper mines that are producing have been producing for 100 years, and you haven't replaced them with new ones. And to me, that's just like one of those flashing lights. That's like, this is a problem waiting to happen, and you want to own it before everybody realizes it's a problem. And for me, royalties have been the way to do it. I mean, other people have had success doing it other ways, but I like the royalties.
There's one piece of news in the copper market that I'm trying to understand better and get the significance of, but I don't know if you've been following the KoBold story. So this is like the newest unicorn out of the Silicon Valley. It's a company backed by Bezos, Branson, Bill Gates, Mark Andreessen, Ben Horowitz, valued at $1 billion now. And their mission is to create a Google Maps of the Earth's crust. And what they're doing is they've partnered with Rio Tinto and BHP. They're investing in copper, cobalt, nickel, and lithium around the world. And, it's not lost on me what they're seeing, right? This is the Silicon Valley Titans seeing exactly what you're just talking about, that the supply constraints are super, super real. And if they can tie up supply of those, specifically those energy metals, right, now is the time to do it. They've been very public about them. They have no intention of becoming a mining company, hence their relationships with Rio and BHP. But they're deploying a ton of capital, and they just put 150 million into a copper project in Zambia. But they're shopping for assets right now, and that's I don't know how significant this is yet, but it strikes me as very significant that there's a new unicorn out of Silicon Valley that's looking at, and they're bringing their own AI tech to expedite the exploration process, because as you mentioned, right, it's kind of been the same for many years, like 100 years. We've been just spinning drills into the earth. We can probably do it better. Much longer than that, actually. Like in ancient China, there's documents of similar drilling processes to find salt brine. It's like nothing's changed in a couple thousand years. But I think it could be really, really monumental if mineral exploration gets attacked by, Silicon Valley billionaire innovation. Wait and see, I suppose. But in the meantime, looking to tie up assets.
Yeah. So that business is very real. One of their key advisors, who was an ex mining company kind of executive titan, I'm in business with his son, so we keep an eye on what they're up to. But it's very real. It's a sign, like what you're saying. It's a sign that they're walking into this industry that is kind of unsophisticated, hasn't evolved much since the 90s, and is not well focused, when it comes to like traditional capital. I mean, there's no analyst that I know of in New York that does a really good job of covering, and you think about that in the context of what they do with other industries. And so they see an opportunity, and I think they're wise. I think that probably they'll be successful. And I think that maybe once they figure out, like Pierre Lassonde always says, the place to find the next gold mine is next to the other gold mine, or something like that. I mean, it's like the highest probability place to find the next mine is next to the other mine. So you're not really it's not like they're going to find, the next gigantic copper mine in a place that's never produced copper, and there's been no signs of copper ever. I mean, that would be rare. Yeah. And so you start thinking about, owning a royalty on the area next to the other copper mine. You just think, man, I mean, if you own enough of those things, it only takes one. That's it, man. That's it. It's done. And the question then becomes, like, do you have the patience? And because you're not going to play that Silicon Valley game like those guys.
Of course not.
Phone call to Andreessen Horowitz is like pretty good, but you're not going to be able to do that. But I feel like what those guys don't understand is how the royalty business works. So there's the edge, right? I mean, it's now I think they can figure it out, but they haven't figured it out yet. And so, yeah, I mean, this is all, we're going to look back in a few years. Like we're going to look back and we're going to write about this, and we're going to talk about how, the answers were all right there, and nobody wanted them, if that makes sense.
Yeah. Yeah. Look, I want to push people to your Substack once more, E.B, because it's excellent. I love that you're writing a Substack now, by the way. Comes out every second Thursday, I believe. But absolutely worth the subscribe. It's super informative, always entertaining, which is nice. It's nice to learn and enjoy it, right? That's really important. And then the upgrade to premium, super, I think, reasonable to get access to your trustee portfolio, which is that bedrock foundation that we talked about for a lot of this interview. It's like, go speculate, sure, but do so from a position of strength, right? And that's what you'll find in the trustee portfolio. Highly recommend.
ebtucker.com is the way to get it. And couldn't be easier. Just ebtucker.com. You can read for free. I mean, there's a lot of people that read for free. When I was younger, I had to read for free, and so I want to return the favor. And you get a lot of content for free. It's not, there's no publisher. There's no tacky advertising. There's, I came from a background of being published for some number of years, and the marketing that you're subjected to when you deal with that is like really taxing, and it really kind of makes it difficult to focus. And so I wanted to avoid that entirely. Now, that means running on a leaner staff, but I think it's worth it because I get to talk to you. From reading that I get to talk. I mean, I'm working on the letter now. So, I mean, so it's like, you're actually, it's me writing to you, and it's a journey, and you're kind of part of that journey. You get to see what I'm up to and what I'm doing. And that's our communication channel.
I love it, man. I love it. Well, look, I want to thank you for coming back on. Always appreciate your time. Enjoy your trip. I know you're on the road right now, so enjoy that. And we'll chat again soon.
Thanks for having me. And I hope to run into you in Vancouver later this summer.
Thank you for tuning in. I hope you enjoyed this conversation. Now, if you want to take the next step, I publish a weekly newsletter and it's free. There's a link to subscribe right beneath this video, and you can join me and 50,000 other investors weekly for this exclusive content where I share my key action items and takeaways from conversations just like this and plenty others. Thanks for stopping by.